Hey there and welcome. So you're ready to make your money work for you, right? To turn your savings into a real wealth-building machine? Good. In the next 5 minutes or so, we're going to pull back the curtain on the U.S. stock market. No jargon, just a straightforward plan to get you started. Let's do this. Okay, so you've got some cash set aside, you're itching to jump into the market. And I get it, that's exciting. But hold on a second. Being truly ready to invest, it's not just about having money to spare. It's about building a solid foundation first, one that can actually handle the ups and downs of the market. It's about being smart before you're brave. So here's our game plan. First up, we'll get your finances in order. Then we'll cover how the market actually works. After that, we'll look at your investing toolkit, talk about some simple ways to get started, and wrap up with what might be the most important piece of the puzzle, mastering your own mindset. All right, section 1, get your finances ready. Let's start right at the beginning with the foundation. Seriously, before you even think about buying your first stock, you've got to build a solid financial wall around yourself. This step, it's completely non-negotiable. And that wall has 2 major parts, 2 safety checks you absolutely have to pass. First, build an emergency fund. Think of it as your financial shock absorber for when life throws you a curveball. Second, pay off that high-interest debt. That stuff is like an anchor dragging down your financial ship. You gotta tackle these 2 things first. Do that, and you'll be investing from a position of power, not panic. So how big should that emergency fund be? Well, there's no magic number. It really depends on your situation. If you and your partner both have stable jobs, you might be okay with a 3-month buffer. But for most people, the standard advice is a solid 6 months of living expenses. And hey, if you're a freelancer or your income is a bit unpredictable, you'll want to push that to 9 months or even more. This is your peace of mind fund. And this chart right here, this is exactly why we're so focused on debt first. Look at this. Your credit card might be charging you, 20% interest? That's a guaranteed loss of 20% every year. Now, compare that to the stock market, where the S&P 500 has historically returned around 10% a year, and that's not even guaranteed. So think about it. Paying off that 20% debt is like earning a risk-free 20% return. You can't beat that anywhere. It is without a doubt the best investment you can make first.
Okay, section 2, how the market works. So now that your financial house is in order, let's pull back the curtain and see where all the action happens. Where does all this trading actually take place?
In the US, it really boils down to 2 big players. First, you've got the granddaddy of them all, the New York Stock Exchange, or NYSE. This is where you'll find the big, established blue-chip companies. Think industrial giants. It's a mix of old-school floor trading and modern electronics. Then you have the NASDAQ. It's fully electronic, and it's famous for being the home of the tech world. We're talking the Apples and the Microsofts of the world. Younger, faster-growing companies tend to live here. But how do they decide what a stock is worth? It's actually a pretty simple dance between 2 numbers, the bid and the ask. The bid is the highest price someone is willing to buy for, and the ask is the lowest price someone is willing to sell for. When a buyer and seller agree, when the bid and ask meet in the middle, bam, a trade happens. That's it. That's the magic happening millions of times a second that sets the price for everything.
And how do we know if the market is having a good day or a bad day? We look at the scoreboards, which we call indices. The big one everyone talks about is the S&P 500. It's a snapshot of 500 of the biggest, most important companies in the US, so it gives you a really good feel for the health of the entire economy. You've also probably heard of the Dow Jones. That's just 30 huge blue-chip companies. And the NASDAQ composite, that one's all about tracking the tech-heavy NASDAQ exchange.
All right, next up, section 3, your investing toolkit. Now, we're going to talk about the gear you need, the right accounts, and the safety nets that are designed to protect you and your hard-earned money. Okay, this is super important, so listen up. You've probably heard of FDIC insurance for your bank account, right? It protects your cash up to $250,000 if your bank goes under. Well, the investing world has something similar called SIPC. It protects your investments, your stocks and cash in a brokerage account up to $500,000 if your brokerage firm fails. But, and this is the key takeaway, SIPC does not, I repeat, does not protect you if your investments just go down in value. It's protection against firm failure, not market losses. Big difference. Now let's talk about where you'll actually hold your investments. The type of account you choose is a huge deal, mainly because of taxes. It all comes down to one simple question. Do you want to pay taxes now, or do you want to pay them later? If you choose a traditional 401k or IRA, you get your tax break today. Your contributions are pre-tax.
If you go with a Roth, you pay the taxes now on your contributions, but then all of your qualified withdrawals in retirement are 100% tax-free. It's a big decision. Section 4, Simple Ways to Invest. Okay, your foundation is solid, you've got your tools. Now for the really fun part. What do you actually buy? And I'll give you 2 keywords to remember: simplicity and diversification. Look, for most people just starting out, you don't need to pick individual stocks. The best bet is usually a broad market index fund. You can buy these in 2 main flavors: ETFs or mutual funds. So what's the difference? Well, ETFs, or exchange-traded funds, trade all day long, just like a regular stock. They also tend to be a bit more tax-friendly. Mutual funds, on the other hand, only get priced once a day, at the very end of the trading day. For most people these days, ETFs are kind of the go-to for their flexibility and efficiency. Want to make it even easier, like set it and forget it easy? Then you'll want to know about target date funds. A target date fund is basically a portfolio in a box that does all the heavy lifting for you. Its secret sauce is something called a glide path. Think of it as an autopilot for your retirement. It automatically gradually shifts your investments from being aggressive when you're young to being more conservative and safe as you get closer to retirement. So what does that actually look like? Well, for a young person with decades until retirement, that target date fund is going to be almost all in on stocks, maybe 90% stocks for maximum growth, and just 10% in safer stuff like bonds for a little stability. But the cool part is, you don't have to touch it. As you age, that mix will automatically glide to become more and more conservative, protecting your money as you get closer to needing it. And that brings us to our final and most important section: mastering your mindset. We've talked about the what and the how, but I'm telling you right now, the biggest threat to your long-term success isn't a market crash. It's you. It's your own emotions.
It all starts here. The market is going up, your account balance is climbing, and you're thinking, hey, this investing thing is easy. This is going great. And then that feeling turns into something more. Wow, I'm a genius. I knew what I was doing. This is euphoria. You feel unstoppable. And let me tell you, this is the most dangerous part of the cycle. It's when people get greedy, throw their plan out the window, and take on way too much risk. And then the market drops. Suddenly, that genius feeling is gone. It's replaced by a knot in your stomach. Uh-oh, maybe I should sell? Maybe this was a mistake. Anxiety and fear start to creep in, and you start second-guessing your entire plan.
And finally, it hits. Full-blown panic. The market keeps falling and you just scream, "Get me out, I can't take it anymore." And that's it. That's the bottom. That's the moment people sell everything, locking in their losses for real and destroying years of hard work. Your number one job as an investor is to have a plan that prevents you from ever reaching this point. So let's put this all together. Here is your 5-step battle plan for success. 1. Build your financial foundation. That means getting that emergency fund in place. 2. Destroy your high-interest debt. Get rid of it. 3. Max out your tax-advantaged retirement accounts like a 401k or a Roth IRA. 4. Keep it simple. Stick to low-cost, broad-market ETFs. And 5, the most important rule: automate everything you can and stay disciplined. Trust the plan, especially when it's hard.
So there you have it. You have to blueprint. The path is clear. You know what you need to do. So the only real question left is, what's your first step going to be? Thanks for joining me.